What if the greatest lie about financial collapse is not that it never happens, but that it's never allowed to happen all at once? We're taught that markets crash because of accidents. Greed gone too far? Bad actors? Black swan events no one could see coming. But here's the mystery that doesn't quite fit. Why does the global financial system keep almost collapsing again and again without ever fully breaking? Why do crises arrive in waves, controlled, delayed, softened, repackaged, instead of ending the system outright? Because collapse isn't the enemy of the financial order. Uncontrolled collapse is. Tonight, we're going to trace a hidden pattern across centuries of economic history. A pattern where power doesn't eliminate failure, it manages it. Where debt doesn't disappear, it's rolled forward. Where pain isn't avoided, it's rationed. And by the end, you may see every bailout, every stimulus package, every emergency measure, not as a rescue, but as a containment strategy. Welcome to its financial history too. To understand this, we need to step back before central banks, before stock exchanges, before modern money itself. Early financial systems were brutally simple. Kingdoms borrowed to fund wars. When they couldn't pay, they defaulted. Sometimes creditors were wiped out. Sometimes kings were overthrown. Collapse was loud, visible, and final. But this chaos had a problem for those in power. It was unpredictable. In the late medieval and early modern periods, something began to change. Italian city-states like Venice and Florence pioneered state debt markets. Instead of defaulting outright, governments issued long-term bonds. Creditors became invested not in repayment alone, but in the survival of the state itself. This was the first twist. Collapse was no longer a clean break. It became something to be delayed, negotiated, stretched over time. The real transformation came with the rise of central banking. The Bank of England, founded in 1694, wasn't just a bank. It was a machine for managing failure. When the British state ran out of money, it didn't collapse, it borrowed. When debt grew too large, it refinanced. When panic hit, the bank stepped in as lender of last resort. This wasn't about preventing collapse. It was about making collapse manageable. As financial markets expanded, so did the scale of the problem. The 18th and 19th centuries were filled with crises. The South Sea Bubble, the Panic of 1825, railway manias, banking panics. Each time, markets seized, credit froze, and ruin threatened. And each time, authorities learned something new. They learned that letting everything fail at once was too dangerous. It destabilized governments. It triggered revolutions. It shattered legitimacy. So they began to intervene not to fix the system's contradictions, but to slow their consequences. By the early 20th century, the financial order had grown enormous. Industrial capitalism required vast amounts of credit. Banks became deeply interconnected. One failure could cascade into dozens more. Then came the breaking point. The Great Depression. In 1929, the system did what it was never supposed to do. It collapsed too fast. Banks failed en masse. Credit vanished. Unemployment soared. Entire economies imploded. And crucially, governments lost control. This was the nightmare scenario. The lesson drawn by policymakers wasn't never allow bubbles. It was never allow uncontrolled collapse again. Out of the Depression came a new doctrine. Central banks would intervene aggressively. Governments would run deficits during crises. Financial institutions deemed systemically important would be protected not because they were virtuous, but because their failure would be too disruptive. The system was redesigned to bend, not break. For decades after World War II, this appeared to work. Crises still happened, but they were smaller. Recessions were shorter. Confidence returned faster. But the cost was subtle and growing. Debt exploded. Governments borrowed more. Corporations leveraged themselves. Households were encouraged to finance their lives. And every time the system wobbled, intervention became easier, faster, larger. By the time we reached the late 20th century, collapse had been turned into a managed process. Then came the rise. Financial globalization, deregulation, complex derivatives. Trillions flowing across borders at the speed of light. Risk was sliced, packaged, and sold. Everyone was connected to everyone else, often without realizing it. This created the illusion of stability. But beneath it, fragility grew. The breaking point arrived in 2008. When the global financial system nearly imploded, it wasn't because no one saw the risks. It was because the risks were allowed to accumulate on the assumption that they could be handled later. When the collapse began, authorities did something unprecedented. They didn't let the system fail. They froze it, they injected liquidity. They bailed out banks. They socialized losses. And notice what didn't happen. The system wasn't restructured. The incentives didn't fundamentally change. The largest institutions became even larger. Debt didn't shrink, it shifted. The collapse was contained, not resolved. This is the key insight. The modern financial order doesn't aim for balance. It aims for continuity. Pain is redistributed over time. Losses are delayed. Crises are smoothed, softened, and spread across society. After 2008, interest rates were pushed to historic lows. Money creation exploded. Asset prices soared. Those closest to financial markets recovered quickly. Those dependent on wages lagged behind. Inequality widened not as a bug, but as a feature of managed collapse. Then came another shock, a global pandemic. Once again, the response wasn't to let the system reset. It was to prevent free fall at all costs. Trillions were created in weeks, markets were stabilized. Debt reached levels once considered unthinkable. And once again, the question wasn't whether this created future instability. It was whether instability could be postponed. Today, we see the consequences everywhere: rising inflation followed by aggressive rate hikes. Banking stresses reappearing. Governments facing debt burdens they cannot realistically repay. Young generations priced out of assets. Older systems propped up by constant intervention. The pattern repeats. Small collapses are tolerated. Big collapses are not. Why? Because the financial order is not just an economic system. It's a political one. Its survival depends on maintaining enough stability to preserve legitimacy, while extracting enough resources to keep power concentrated. Collapse, when controlled, serves a purpose. It clears weak players. It disciplines labor. It justifies emergency powers. It resets expectations without resetting the system itself. But this strategy has limits. Every managed collapse leaves behind more debt, more distortion, more fragility. The space for intervention narrows. The tools become less effective, the consequences harder to hide. History shows us that systems don't collapse from one event. They collapse when their methods of avoiding collapse stop working. So what does this mean for us right now? It means the calm after a crisis is not proof of health. It may be proof of postponement. It means stability built on constant emergency measures is not stability, it's dependency. And it means the question is no longer if stress returns, but how much can still be managed. Let's end with 3 clear takeaways. First, financial crises are not failures of the system, they are part of how it functions. The system survives by controlling the speed and visibility of collapse. Second, every intervention has distributional effects. Who is protected, who absorbs losses, and who waits the longest to recover is not accidental. Third, delaying collapse does not eliminate it. It transforms it often into something slower, quieter, and more unequal. The open question is this: what happens when collapse can no longer be managed? When the tools lose credibility, the debt becomes unrollable, and confidence finally breaks? That answer isn't written yet. But understanding the pattern is the first step towards seeing what others are trained not to notice. If you found this perspective valuable, take a moment to reflect on how often stability is used as a justification and who pays for it. And if you want to keep exploring the hidden mechanics behind power, money, and systems that shape our lives, consider subscribing. Because the most dangerous collapses are not the ones we fear. They're the ones we're told have already been handled.